Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Costco Wholesale Corporation, ticker COST. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $243 billion and an enterprise value of $238 billion. So you can see some net cash on the balance sheet. They're not really using leverage in this business in order to get their returns. That's always a good sign. Something else that's interesting to me is the $531 stock price. Tends to mean that they're not in the practice of doing a lot of share splits. Otherwise, a lot of companies would have already split their shares by the time they hit a price like that. It tends to be a positive sign in terms of capital allocation, how management thinks about their shares. Industry is in the food and staples retailing industry. So Costco engages in the operation and membership warehouses in the United States, Puerto Rico, Canada, UK, Mexico, Japan, Korea, Australia, basically all around the world. I believe they're mostly focused in the U.S., but that's a large number of places. Here you see 815 in the U.S., 815, 564 of which is in the U.S., 105 in Canada, 39 in Mexico. So, vast majority is in the United States. Branded private label projects in the range of merchandise include sundry, dry groceries, candies, coolers, freezers, liquor, all sorts of things. Basically, these are very large warehouse type grocery stores that offer non-grocery products as well, a very large number of items. From my understanding, having visited various Costco's, is you can expect very low price products in very large quantities. So the beta is 0.70. Lower beta is usually a good sign of a high quality company. 0.70 is quite significant for a company of this size of $243 billion. So very good signs of quality company right there. Next thing that we can see is this chart of return on invested capital exhibits all the signs of a high-quality company. You can immediately see that they have 20 straight years of profitability. There's not a single loss. 20 straight years of profitability is a very good sign for a successful high-quality business. In addition to that, you can also see very strong stability and a lack of cyclicality. There's no cyclicality in this business. You can clearly see that they're not dipping and jumping up and down. There's no ups and downs. It's just a fairly stable numbers year to year. You do have some changes, but they tend to be small and over longer periods of time. For instance, look, 2010, you're at 10.18%. 2011, 10.26%. Very stable and strong return on invested capital. You basically spend the majority of the last 2 decades over the 10% line, and certainly the entire last decade has been over the 10% line. In addition, you're starting to see some really good returns on scale because you're seeing the movement here from 2011 at 10% all the way up to 17% return on invested capital over the last decade. So the returns are improving, and they've crested above a really nice 15% mark over the last 5 years. So very, very good signs here. You can see the 10-year median returns on invested capital at 14.3%, and so you're trending upward, but you're also at a very strong number. I like this number to be above 10%, and I want the return on equity to be above 15%. You're meeting those quite well. So in addition to the stability numbers here and the growth number of this number, you're on an absolute basis, you're in a very good camp for a high quality business. So everything I'm seeing says high quality business for Costco. Now, valuation is where it becomes interesting. You have a PE of 43, price to book of 11, price to sales of 1. Now, what's interesting is the big gap between price to book and price to sales. Now, some of that is we might have buybacks in the picture. We're going to have to take a look to see if buybacks are being used to juice this gap. But certainly you're paying a high price to earnings ratio. It would be one thing if it was 43, but the price to book was low, price to sales was also low. But clearly what we're seeing here is this is very high priced. And what it is because everyone appears to know that this is a high quality business. You have a business at this size, $243 billion. It shouldn't be a major surprise that it's well known and is that it is a high quality business. You can also see from the gross profit margins here, 13% gross profit margin, 3% pre-tax income margin. This is running very tight margins, very low priced products. And so it's going to be all about high turnover in this business, which is especially important for retailing, food and staples retailing like grocery store. High turnover, that high turnover drives the returns for the business model. Now, what's interesting to me is you're paying 43 times earnings, but on only 8% revenue growth. Now, revenue growth and assets growth is matching pretty similar. Again, that's common for what I believe Costco's business model is. They're trying to use shared economies scale. They're trying to return their savings to customers, and that's what you're seeing here. But they're driving 8% revenue growth into 13% EPS growth. You can do this a few ways. Could be some operating leverage in the business. Could be share buybacks. We can see more as we dive in. One thing I like to see with this revenue growth of 8% is it's not all front loaded. You have some years here, 3%, 2%, but it's not all most recent years. You do have the last 5 years have basically also met or exceeded the 10-year growth rate, so they're not slowing down. You have 17% growth even in 2021. They did quite well through the pandemic. You can see just continuing stable growth, and that has been quite well. You see this gross margin has basically hugged 13% the entire time. Very strong stability here, very high quality company from those numbers. Now, you have seen a little bit of growth in operating margin. Again, that's some of your operating leverage you're seeing. It's not a huge amount, but it's sufficient to still get you very strong growth. I mean, look at this. You went from $3.89 per share to $11.27 per share, almost a tripling across the decade. Very strong returns. That's where that 13% is coming from. So you really like to see that. Again, going from $1. You also basically tripled your dividends from $1 per share to $3 per share. So very strong dividend growth as well. Every single year has been a double-digit dividend growth. Anytime you see that, you can be excited as an investor that you're going to get a pretty strong return. So everything I'm seeing so far is that Costco is a very strong business, but at a potentially high price. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe and ring the bell so you can get notified as I upload new videos each and every week. Right now, it's Monday, Wednesday, Friday, where we're covering 3 companies in the S&P 500 every week. And if you want to see the backlog of all the companies I've done so far, over 100, then I have a playlist at the end of this video that links you to my entire S&P 500 coverage. So let's go to the income statement. Now, one thing you can see here is the cost of goods sold, again, growing in line with revenue. They're not trying to win on that line. You also see basically they've grown their SG&A 2x. They've grown their profit 2x. Not a lot of operating leverage here, but just a little bit. And that's been enough to really drive really strong returns. Now, what's interesting is I predicted that maybe they had been doing share buybacks, but I don't see that here. The shares outstanding is pretty stable. They've actually gone up a little bit over time, not much. You started with 439 million shares at the beginning of the decade, 444 million at the end of the decade, and for the last 3 years, it's been very, very stable. So they're not diluting you, and they're not really buying back shares, just stable on the VPS line. Balance sheet. Again, PP&E, all of that's matching out very clearly. You can see everything's kind of growing in line. This is a retail business. They're kind of rolling out new stores. That's what this is showing. And that's just growing the business along those lines. It does mean maybe they have a large potential population of where these stores can be. I'd be curious because I think they do target higher income customers in the U.S. and the U.S. is already a very high income country. So I am hesitant on understanding what their total addressable market might be, but it's been growing very strongly across the decade, and you can see it in those line items. Let's go to cash flow. One thing I like to see is you haven't grown depreciation and amortization a huge amount. It's basically a little less than doubled, kind of matching your PP&E and lagging it a bit. So the PP&E is drawing that line, but it's not a huge portion of their free cash flow. You're not seeing depreciation being 100% of this or 2/3 of it even. It's maybe 1/3 of your free cash flow or less to depreciation and amortization. So it's not a huge CapEx type business. Also, acquisitions are quite low, which is kind of nice. Actually, what's very interesting to me is that you do have large stock-based compensation. $665 million in stock-based compensation over the last year, $700 million last 12 months. It looks like they're offsetting that by buying back shares. Very interesting how that's paying out and how they've avoided growing the share count with the way these numbers are set up. It doesn't make sense to me how they're able to buy back that amount of stock-based compensation with what I see here. Key ratios. Let's go to debt. Let's see what their debt situation looks like. So they have some long-term debt, but I think really key here is, of course, is probably they have capital leases. These are retail locations. That's going to be a big part of how this business is being run. So they're not running with a huge amount of debt. $6 billion in debt across $26 billion in assets. Not a huge amount, but you do have these capital leases, and that's going to be matching off against Actually, I don't even see it on here. But you do have capital leases, so they're, of course, renting or owning stores, and that plays a big part into it. Everything here looks great. Where I question it is going to be really this income line. So you have $5.6 billion in income, right? But the company is $243 billion. It's just huge. This is a huge business. What's the income statement? $12. So you say $12, 20, 25, 30, 43. Yeah. So there's nothing weird about this number. This is just a high price. So I love what I see here. I think Costco should certainly be on my watch list. It should certainly be on many people's watch list for those interested in a high quality company. They're clearly executing well. You don't have one hit wonders on a year. Very stable margins, very stable and growing return on invested capital. I love everything I see except the valuation. This price is simply too high for me to be interested. I'd like to pay half this price or less, really less than 20 times earnings for a business like this. Which 20 times earnings on a $12 income statement, you're talking $250 a share. You're trading for $531. I doubt I'll get that price, but it would probably need to be under $250 a share before I even get interested. If you enjoyed this video, please hit the like button. Don't forget to subscribe and ring the bell. I need your likes and your subscriptions in order to grow the channel. Helps YouTube know that I'm producing good content. So if you enjoy that content, let YouTube know. Hit that like button. Don't forget to be a subscriber. If you're enjoying the software that I'm using to do these videos, you should consider signing up for quickivest.net. You can do so either as a free member or paid, but either way, use the referral link that I have in the description below. It's the first link, refers you to quickifs.net and lets you know that I sent you over there. If you sign up and you get good value out of that content, then I get a commission from that sign up. It's no extra cost to you to use my link. It's just a way that you can support the show by signing up using my referral link. Thank you for listening, and until next time, stop paying fees, start building wealth.